welcome to yet another episode of Axis Mutual Funds podcast series. Today we have Nitin Arora with us. Let me introduce Nitin to you guys. Nitin has been a veteran in the mutual fund industry with over 17 years of experience. And with Axis, he's been there for around 7 years. Nitin looks at key equity schemes with us. And one of the schemes that he looks at is Axis Value Fund. So today, let's dive into Axis Value Fund, Nitin, and we have like a few questions that we have as well as a few questions that the audience will, kind of tell us. So let's straight up get into the topic. First thought that comes in my mind is, what is Value Fund? Could you give us an idea on that?
I think when you look at value investing, there are 3 to 4 areas, where a fund manager or investor looks at it. One is that people look at valuations, the low price to equity, the low price to book. The second aspect, can these different companies can set for a re-rating? That's where the value emerges and the alpha generation happens. The other way of looking at value investing is, we normally see a lot of government boost comes in a lot of sectors, right? And that generates a lot of value to the investor. So I'll just give you an example here,
Sure.
which will help your audience to understand. Is when you look at defense, for example, 4 years back,
Yeah.
5 years back, right? That was something which was ignored by the market.
Yeah,
But government gave a lot of boost to the sector, and that became the pretty high re-rating sector.
true.
Number two, what we have seen in the recent case, a lot of mid-cap and small-cap financial banks, which were trading at almost like subpar book, 1.1 book, they have been certainly being re-rated to about 1.5 book. So there was a lot of value. We were invested there. And that became value because a lot of liquidity came to from the global PEs and private equities into these banks. The earnings growth certainly from 10% became 15-18%.
Okay.
I think what is more important to look at when you come to the aspect of value investing is, these are 3-4 parameters one should look at it. Definitely valuation is one parameter, but second, earnings growth. Third, any government boost to the sector. And fourth, the most important thing, are these companies where you're betting on that, with the aspect of they will create value, whether there is a market share gain or not. So what is more important, because there are a lot of funds, in the market with respect to value aspect. But I think what is value to us is more important. And I
Yeah,
think what I
true.
said about the 4 parameters, those are important for value side.
Absolutely. In fact, that was my next question. And if you could add to that, what does value mean for Axis Mutual Fund? Like, do we look at value in a little different way? So if you could help
Sure.
us there.
So I think what is value to us is more important. We don't only get into an aspect of low PE stocks, right? If that would have been a case, large cap IT would have got re-rated 4-5 years back. The reason for large cap, and I'm definitely giving you an example here, the large cap IT companies have been the lowest PE multiple when you look at relative to the market multiple today. But still they are not getting value because the earnings growth has been muted. Okay. However, when you look at value investing, and what we look at in a company specific is, for example, a market share gain, okay, premiumization. Then we also look at the government boost to the sector. And we also look at very aspect, the governance angle, the management change. Is there a kill to grow some loss-making companies to the profit-making companies? Can there be a re-rating in the multiple because of the consistent earnings growth? So, for example, in starting of the interview, I talked about defense, right?
Yeah.
Defense is the only sector when you look at, and even it's one of the companies are there in the Nifty
Yeah.
as well. They have grown at 15-18% CAGR, right?
Yeah.
So that due was there for the multiples to get re-rated. Second aspect, what we look is definitely, is there a rate of change in the free cash flow of the company? Okay. A lot of people miss that, because you have to be, as a value fund manager or a value investor, you have to catch the rate of change. Okay.
Could you explain that in a
Sure.
little simpler
So when
way?
I say rate of change is a company from a negative cash flow, is there a chance of becoming a free cash flow company? We have seen a lot of cases, okay? There are a lot of auto giants and auto companies who had very big global exposure. Certainly from a loss-making company, they became a profit-making company
Yeah.
because of the change in the whole auto sector. We talked about auto ancillaries, right?
Yeah.
Auto ancillaries was one time was not used to get more than 15 P. Today, people are ready to give them 30 P earnings. The reason is very simple, because they're growing at 20% CAGR. Not many companies are growing in our country at 20% CAGR. So I think those are the areas what we look. And those are very important aspects because the rate of change of earning changes, the multiple re-rates very faster. So it is not really necessary that you should always look at low P. You should look at in conjecture of how the earnings growth, the rate of change, the rate of change of cash flow, and the most important thing which one should not leave, your companies are gaining market share or not. So these are 3-4 parameters where we look to invest, and then that's how we try to create the alpha generation in the fund.
Great. And you touched upon auto and you touched upon defense. Overall, how is the market looking like India market looking like? It's currently quite overvalued. So how is it looking like for you specifically in terms of value?
I think when you look at this juncture, I think the most important thing is that we have been very resilient despite being the tariff shocks. When you look at our earnings growth of the Nifty or the Nifty 150 mid cap or a small cap index, that's been pretty resilient despite taking a tariff hit by a lot of companies. Now, important juncture today is that the tariff deal should happen, right? That's the first catalyst what we are looking for the market. The second thing, the important aspect is inflation. Rather, I would not say a deflation, but inflation is very much under control. RBI has cut, rate cuts in a massive way. Now, what is it? It's telling you, and as a fund manager, it's very important when a country is going through a deflation or a low inflation, you need to bet on companies which has the capability to gain market share. And that's how the portfolio has been designed across our schemes. The other important part, what we are looking for the market at this point is we feel all these things which are done by the government, as well as the earnings growth which are coming up, not disappointing the way Street was thinking 2 quarters back. If those earnings sustain for the next 2 quarters along with the tariff deal, I think market will get its catalyst and we should do well in the next 1.5 years, because underperformance has been massive against the other emerging market and the developed market. So I think we are very constructive. Though we feel it's not a very broad rally, it'll be very, very stock specific companies which will do well. And that's where we are betting on.
How does our fund stay clear in terms of value traps, and how do we maintain exposure in value stocks?
So I think when you look at, there's been a lot of questions being asked to me that, look, it's a very low P stock, why you're not there? Someday the earnings would come in. I think, and that's the reason we always say that it is very important in this market, and especially in value, because you find value in a lot of mid cap and small cap stocks. When you go on that side, you need to be very clear that is that company has the capability to get some market share in that segment wherever it's present. Number two, other management is very agile in terms of getting that pullback in the market share. Can the rate of change in cash flow that can happen or not? I think these are some of the 3-4 parameters which are the first thing for us to look after before going to the valuation argument. And that's the reason you see when the mid cap and the small cap rally fizzled out in the last 1 year, not too much activity have been seen, and there are so many promoter selling companies at this point in time, reducing its stake. There are very few companies who are investing for growth in that company. And that's the reason I took example of Autoanks, right? Those companies saw re-rating. And despite people Street argued these are expensive, the multiples still went going up because the earnings growth was going up. So I think value trap is where the investor gets stuck on just looking at one aspect. Look, the stock is down 50% in a year. It's very cheap. Let me get into it. No, I think it's a pretty no-no for us. What is more important, if it's down 50% just because of cyclicality, we are very much interested. But it's down 50% just because of the market share loss, earnings growth not coming, we are not there, because we feel once your market share goes down, it's very difficult to catch up.
So you briefly touched upon leadership of the organization when you kind of look at stocks. I wanted to check, what are the key attributes that you look at specifically to terms of leadership of a company in terms of choosing a stock?
Sure. So I think the important aspect is how much they are spending in R&D. Okay, that's very important. And because of mid-cap companies' market cap and small-cap companies' market cap have become bigger, I think the promoters of these companies are also becoming very agile to where to invest in that R&D. We have seen a rate of change, especially with the mid-cap and small-cap companies. They are really investing pretty much in the R&D side, on the technology side. And that's what we believe the reason for their higher growth versus the large-cap companies at this point in time. Okay. The other parameter, what we look is very important, that are these companies really going for growth or not? Because if you're just keeping your cash flow to yourself and you're not investing further in the growth aspect, I think market doesn't re-rate your multiple. So I think second aspect what we look is, are they really investing in the right areas, in the growth, in the talent? And that's the reason, lot of I'll give you one more example which will help you understand. There are not many enough small cap and mid cap defense companies which were able to scale, okay, because they didn't invest too much in the R&D. And again, I'm going back to the same example of auto ancillary. When the whole premiumization of SUV started, these companies really invested very hard, in the technology side, even in the battery side, motor side. Now we are the largest producer of electric motors. So I think when you look at these aspects, these are very important aspects what we look, when we look at the leaders or the growing company should be there.
So by R&D, you mean only like research and development or other multiple things there?
Sure. So I'll give you an example that will help your audience to understand. So when this whole saga of rare earth material started, China will not give us a rare earth material. We are now almost 15% of penetration of electric scooters in India. Who will, get the rare earth material from, and how will make the electric motor? Because these companies were investing in motors making X of rare earth, we are actually now every new scooter which is getting produced is now with a free rare earth material.
Oh, wow.
Okay, and that's the reason today China is not a threat to us with respect to this aspect. But what it tells you also, a lot of companies is they have to keep investing, because this is what our belief is. This tariff regime, this geopolitical thing is now a very much inherent part of the investing.
Yeah.
So that's one thing the investor should keep in mind.
Great. So we touched upon, multiple aspects in terms of electric, autos, defense. What are the other themes, sectors that you see upcoming in the coming year?
Sure. So I think there are not enough themes left, to be very honest, in the market. I think very much whether you look at auto premiumization, auto angs doing very well. Defense is one theme which market picked up very well. Then you just come down. Hospitals was one which is consistent being doing at growing at almost 20% CAGR. So I think and retail, for example, has done very well for the country, and even the earnings growth are very strong. I think the only theme which we believed in the last 6 months, which market was not giving too much re-rating, was mid cap and small cap financials. And I think that has done very well in the market. I think that was a very unidentified theme in the market which was left. So I think these are 5-6 areas where I think the earnings growth potential is still there. Government is investing a lot. Okay, we have not seen any signs of slowdown by the government side. So I think one should be investing in these, and should hold on to such areas where we feel the earnings growth would sustain, or rather might see some earnings upgrade coming into it.
Great. And what sets us apart in terms of, while we've looked at the whole set, what sets Axis Value Fund apart from others
Sure.
in the industry?
So I think when you look at, we have been shied away from investing just from a perspective of a PE, okay? And that's the reason you look at Axis Value Fund since last 4 years. We have been very, very actively running those funds. That fund with respect to taking bets on larger themes, okay? It's not that when we own auto angs, we own just one name. We have a basket of, auto angs. And I'm just giving you an example that as a theme we try to capture. Whether it comes to defense, whether it comes to mid cap, small cap financials, we have done that way. Pharma has been a very, touchwood has been a very great sector for us in the last 4 years, had a great run. So I think when you look at differentiation, the differentiation comes more from 3-4 areas. One is what is value to us. And as I said, we try to catch the rate of change rather than just pure value as a investing. We try to capture where there is a capability of faster multiple re-rating, because we believe when market becomes lack of ideation, if there is a management agility and R&D spend is good, there could be a 6 months away that area, but once it catches up, I think the re-rating happens very faster. For example, we've been very heavily invested in the renewable sector. There's a lot of disbelief in the market, but we believe that the localization in the cells will happen in India. And India will spend a lot on the renewable side. So when you look at the themes what we have in our fund versus what the peers would be having, it's pretty different, barring some of the large cap companies which everyone owns. So that's how we try to be differentiating.
Great. So you touched upon re-rating. Could you elaborate there a
Sure.
little bit?
So I think when you look at the re-rating part, is one is when there's been a consistent earnings growth
Hmm.
and multiples don't increase. Okay. And that's why the investor gets very frustrated that, the company is compounding at 18%, 20%, why the multiples are not going up.
Hmm.
And suddenly, when we see a re-rating case that at that 18% CAGR,
Hmm.
if market shares gain starts happening for a company, we have seen multiple gets from a 20p to 35p or 40p very fast. Okay, it could be a reason of high liquidity in the market. It could be a reason of lack of ideas in the market. But you have to be very very clear that this company will continue to grow. So
Hmm.
that kind of a re-rating that happens, that gives a very high alpha generation,
Yeah.
in the fund. Number two, the re-rating also happens that because of geopolitical issue,
Hmm.
which companies are investing at the right areas. So for example, we saw a lot of bankruptcy happening in the European auto ancillary side. Okay, and we are seeing very clearly those businesses are coming to India and are doing for the luxury OEMs. So we feel that's another value area where we feel that these companies will get a lot of businesses. Today they are not getting multiples, but once people start seeing in 6-12 months down the time that these earnings growth are getting captured, the multiple re-rating happens very faster. So
Okay.
earnings growth might remain that 18%, but your multiple starts going up.
Got it. Great. So, to kind of summarize this, what would you tell our audience to look out for in the value space?
I think one, the investor has to be very, very patient in this value investing because there are a lot of moving parts. And as I said in the starting of the interview, that your tariff, your geopolitical risk now are a part of investing. Okay. And that's the reason you see so much volatility in the market. Number two, I think when you are investing in a value fund, you need to think of a horizon of 3 to 5 years. Why we say so? Because there are a lot of companies which we bet on. We don't try that, okay, once it delivers, then I come in the company. We try to preempt at least a year back. Okay. And there could be a scenario where the companies don't perform for a year, right? And that's where I think value investing is something should be seen for 3 to 5 years horizon for any investor. It is not a fund which will rally just because there's a rally in multi-cap and small cap. Okay, because there are a lot of funds, for example, multi-cap, right? When you get a good rally in mid-cap, small cap, they will actually do very good. But I think in a value fund, because we try to preempt a lot of values, where we feel that could be a faster re-rating, earnings growth can catch up. And there could be times where 6-8 months alpha generation could not be there. But what we have seen over the past 4 years, and even when you look at value investing over the last 15 years, those funds have done very well because once the re-rating happens, the alpha generation catches up. What you have not done for a year, you actually make up for next 2 years. So I think one has to be very patient in value fund, in investing. Number two, you need to track earnings growth of your portfolio. That's very important because otherwise it becomes a value trap at the end of the day. So I think these are 3-4 areas what we recommend always.
Great. So, thank you so much, guys. We have covered most of it. I have like a quick, session with Nitin, like a quick fun session where we will be covering short answers, Nitin. Let's go for it. What is that one word that defines value investing for you?
I think market share. That's very
Market
important.
share. One metric that you never ignore before picking a stock.
Rate of change of cash flows.
Okay, great. What is the biggest myth about value investing in today's world?
I think just a cheap stock, so that is value to us. So I think that's something, a very big myth, and I think investors are understanding now.
Yeah. So in fact, that is my next question. Would you buy a stock just because it's cheap? Of course not, but give me some additional.
So I think when you look at, and that's an example I gave you, global IT companies, right? Today, the global US IT companies are cheaper than our companies at this point in time, okay? And our IT companies. Now, the debate for investor is, should I be there or should I be in India, right? Obviously, Indian companies growth a little higher. But I think, for example, there's a lot of AI story at this point in time, right? But if that AI bubble goes off, right, that's what we are reading across, there could be some tailwind that Indian IT can catch it up. So that's not only purely a investing based on a low PE. There are a lot of conjecture around it. So I think just because it's a low PE, low price to book, I think one should not get that trapped here. And that's the reason I said, and again repeating for the viewers, is today geopolitical thing and tariff is a part of the investing. You have to be very, very clear where you're investing, because we feel not our country, but I think every country will localize more. And that's the reason you have to be very clear, even as a fund manager, that you should not get hit just because some country really fixes up his own issues. So I think those are some of the areas where we look very thoroughly, very carefully now. And just because it's a low P stock, we should not be there.
Great, great. I think that summarizes the entire value investing very well. Thank you so much, Nitin,
Thank you.
to be part of this episode. Thanks, guys.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.